Hello and welcome. This is Adjusting Entries Part 1 Overview by Bennett Tchaikovsky. Disclaimer and copyright notice. The information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. I encourage you to share the presentation and share links to this presentation on an unmodified basis. If you do modify the presentation in any way, please email me prior to doing so at 1812cpa@gmail.com to discuss. Note the author does not claim any copyright whatsoever in any companies or organizations mentioned in this presentation. Rather, the other parties are the owners of their own respective copyrights. So before we get started with adjusting journal entries, you need to be able to do the following. And that is posting the raw transactions or posting transactions into T accounts, creating an unadjusted trial balance, and that's when we're totaling each one of the individual T accounts and making sure our total debits equal our total credits, preparing an income statement or revenues less expenses, preparing a statement of retained earnings, which is our beginning retained earnings plus net income minus dividends gives me ending retained earnings, closing out all of the temporary accounts or revenues, expenses, and dividends to retained earnings, preparing a post-closing trial balance, and then preparing a balance sheet. If you do not know how to do this before watching this video, it is going to be very, very difficult. I have had students who do not do well on the first exam, and kind of what the challenge is that they get to want to start studying for the second exam, but if you have not mastered the items from that very first section, it is going to be extremely difficult, if near not next to impossible, because when we go through and record transactions, it's going to go very, very quickly. So if at this point in time, if you don't have a real comfort with these 7 items, please go back and practice. So the one thing you'll notice in my prior video sequences just on recording basic transactions is that whenever I've used things like a loan payable or a loan receivable or equipment purchases or prepaid insurance, all of those items took place, or all those transactions took place on December 31st. And there was a reason behind that. As well as the other prepaid accounts, basically cash paid for future services that we were to receive in the following year, unearned revenue or cash received for future services that we were to perform in the following year, office supplies. And why was this done? Well, accounting is a skill, and that skill is built in layers. The challenge is that if I gave you a loan payable that was issued on any date other than December 31st, you have a problem, because if I've borrowed money, I have to pay interest, because essentially interest, or interest expense in this case, shows the use of my cash over a period of time. Similarly, if I purchased equipment on any other date other than December 31st, you would have to show the use of that equipment in the form of depreciation expense. Therefore, some transactions, after we initially record them, will require us to make adjustments. And when we're creating adjusting entries, now I also have in here parenthetical journal. Right now, I'm going to continue using T accounts. You can make journal entries, find the video that I have on my channel. It's public. It will show you how to make a journal entry out of T accounts. Same thing. I like using T accounts. It's easier for me to understand. If you don't understand the T theory of accounting, please go back and look at my other video. But once the initial transactions are recorded, we're going to ask ourselves the following questions. So When we're doing adjusting entries, we're going to record everything first. So this part here, post raw transactions in the T accounts, create an unadjusted trial balance, that's not changing. At this point in time, though, we need to be asking ourselves the question, do our assets reflect the future economic benefit? Meaning, if I have an insurance policy, has any of that insurance policy expired? If I have a loan receivable, does my borrower owe me interest? If I have property, plant, and equipment, mainly equipment, have I begun using that equipment? And so I need to show the use of that equipment via depreciation expense. So again, do our assets reflect the future economic benefit? Do our liabilities reflect our future obligations? If I've received cash for future services to perform and I start doing that work, do I still have the same amount of unearned revenue? If I've paid for, or if somebody has been giving me expenses, or someone has been providing me services, and I have not yet paid for them, that's a liability in the form of an account payable. The other ones here is, do our revenues reflect what we've earned during the accounting period? So if I've performed services, whether or not I have invoiced somebody, doesn't really matter. I still need to go through and record those revenues. And likewise, do our expenses reflect the benefit of what we received or items used during the period? And that would be the form of the depreciation expense, prepaid, or essentially insurance expense. So what we're really doing here is that once we've made all of our initial entries, we've done our unadjusted trial balance, we're then going through each of the accounts and saying, well, does this look correct given the additional information? And this is really the concept behind adjusting entries. And again, over here, we only make adjusting entries after we have recorded the initial transactions into the T accounts. After making our adjusting entries, we need to ask those questions, A through D, to make sure that are those ending balances in my assets, liabilities, equity, expenses, and revenue are correct. Notice one real important thing here. We don't touch cash, and we never make an adjusting entry that involves cash. That would be as a result of an error. We're not dealing with that in this section. You never adjust cash. Don't do it. Don't touch the cash. It's got die packs. The numbers are sequential. We're going to get busted. We got to get out of here quick. So it's really important that whenever we're making an adjusting entry, you never debit or credit cash at all. What we're doing is we're going to be looking at those asset, liability, and equity accounts, making sure that they properly reflect those amounts. And if we go through here, and as we look at our expenses saying, do the expenses reflect the benefit? Do our assets reflect the future economic benefit? And when we look at those items, it's going to make a lot more sense. So the typical adjusting journal entries, and yeah, this is a lot of fun. And so I have gone through and we'll be making separate videos on each one of these items. Great, good times, there we go. So when we're looking at transactions, these here are the initiating transactions, and DC, obviously debit credit. When I have a loan, if I'm borrowing money, it's cash, I'm debiting cash and crediting loans payable. My adjusting entry for this transaction here will be a debit to interest expense and a credit to interest payable. Does that adjusting entry ever change? The answer is generally no. When I'm giving somebody money in the form of a loan, I'm debiting loan receivable and crediting cash. My journal entry to reflect the adjustment will be a debit to interest receivable and a credit to interest revenue. Will that journal entry ever change? No, okay? Then here, if I'm acquiring equipment, I'm either paying it with cash or cash and notes payable or a combination thereof. The adjusting journal entry that I make is going to be a debit to depreciation expense, which is an expense account, and then accumulated depreciation equipment, which is what we call a contra asset account. Very important here, we do not credit the equipment. We use this contra asset account. I have a separate video. It's gonna be a long one that I'll go through and explain how this works. When I buy an insurance policy, I'm debiting prepaid insurance. Why? It's showing me my, usually an insurance company would never let me pay for something that's happened in the past. I'm only paying for the future. So right here, I'm debiting prepaid insurance and crediting cash. And here my adjusting journal entry is going to be insurance expense, crediting prepaid insurance. Here I've got a debit to cash, credit to unearned revenue, and this is if I've been paid in advance for services. So my adjusting entry would be a debit to unearned revenue and then a credit to revenue. Here I've got prepaid expenses in cash if I'm prepaying consulting expenses, and then to show the journal entry, it would be a debit to expense and then a credit to prepaid expenses. Over here, I've got office supplies in cash, and so if I'm purchasing office supplies, which are assets until our employees steal them, the way I'm going to adjust this, I just violated my rule. Tchaikovsky is in huge trouble. Wow, good. Wow, Bennett, you're falling apart here. This is terrible. Okay, office supplies expense, and this is office supplies. Wow, I'm gonna have to fix that on all those future videos. Okay, so if I bought office supplies, I have to show the use of those office supplies by debiting office supplies expense, and then I'm crediting, debiting office, I almost did it again. I'm debiting office supplies expense and crediting office supplies. Then over here, if I'm prepaying for rent, here it's gonna be prepaid rent cash, debit to rent expense, credit for prepaid rent. Now, the one other thing I've put here is that if right down here, and I'm going to try to do this so you don't have like this little thing going on at the bottom. Hopefully this will kind of, oh, there we go, kind of went away. So I can also have a contract where a contract signed where no cash is involved. And when we have a contract that's signed where no cash is involved, there may be some disclosures, but generally I don't really do anything. And if I'm performing services, I still need to recognize revenue even if we have not been paid. And if I'm receiving services, I need to recognize the expense even if we have not paid for the services. So those are the journal entries that we're going to be covering in subsequent videos. Now, how is this next part different than what we did before? So when we're doing adjusting journal entries, what we're doing, or when we're pairing adjusting entries, 1 and 2 are still the same. We're still going through and posting the initial transactions into T accounts. We're making an unadjusted trial balance. But then once we do that unadjusted trial balance, we're asking ourselves those 4 questions. Assets reflect future economic benefit. Liabilities reflect our future obligation. Expenses reflect what we've used in the period. Do our revenues reflect what we've earned in the period? So then I'm gonna have to make adjusting entries, and then I need to do an adjusted trial balance. So those are both new. So what's the difference between unadjusted and adjusted? The adjusted trial balance will include the adjustments we're making from the T accounts. The next thing I will do is I will prepare an income statement based on that adjusted trial balance. So that process is the same. I'm preparing a statement of retained earnings, same thing. I'm closing out all of the temporary accounts, revenues, expenses, and dividends to retain earnings. That part is the same. Post-closing trial balance showing my temporary accounts going to 0 and the balance going to retain earnings. That's going to be the same. Lastly, what I'm going to be doing is I'm going to be preparing, a balance sheet. But this time I'm going to do a classified balance sheet. Does that mean classified Edward Snowden? Does that mean classified top secret? Now, what it means is that when I'm looking at a balance sheet, remember the balance sheet is really the cornerstone. It's the AELOE. And what I'm going to be doing differently is I'm going to be showing here with a classified balance sheet is that it's really segregating assets into current assets versus non-current, and liabilities into current liabilities versus non-current liabilities. And what most companies do, and I'll show you this in a moment, they just kind of list out the current assets and the current liabilities, and then they just dump everything else below. And I'm sure they're doing that for legal reasons. I'm sure some attorney said, wait a second, if we call something a long-term liability or we show something as non-current, and then all of a sudden it turns out it was due tomorrow or day 366, then we're going to get sued. So that's probably what happened. So what is the difference between a current versus a non-current asset and a current versus a non-current liability? What is an asset? An asset, again, is giving us future economic benefit. And the examples for current, and the key is here, current is I'm going to use it within 1 year of the balance sheet date. So examples for current assets would be cash, accounts receivable, inventory, prepaid expenses, if I'm going to be using them in a year, loans receivable, if I'm going to be paid back within a year. Other ones could include marketable equitable securities, if I'm going to be paid back that within a period, within a year, if I could liquidate it within a year. And that as opposed to non-current assets. What are non-current assets? Those are assets that are giving us value over a longer period of time. Equipment, goodwill, intangibles, loans receivable that are due beyond a year. I will talk about goodwill and intangibles in a later video. And in fact, I think that later video is out there already. So if you want to jump ahead and check it out, you're more than welcome to do so. What is a current liability? A current liability is defined as an obligation that will need to be repaid or services that will need to be performed within 1 year of the balance sheet date. Examples here include accounts payable, unearned revenues, if the service obligation is to be performed within 1 year of the balance sheet date, loans payable, if the loan payable has to be repaid within the year, and accrued liabilities. What are non-current liabilities? Not long-term debt. Could be a loan payable due beyond a year, bonds payable, it's a form of financing. And so those all have to be repaid 1 year from the balance sheet date. Note, I'm not making any changes when I'm doing a classified balance sheet. I am leaving owner's equity alone. So I'm leaving owner's equity alone. I'm just making modifications to my assets and to my liabilities. So let's go ahead and pause real quick. So here we're looking at Facebook, and this is Facebook, and this is their balance sheets as of December 31st, 2018. So we're talking about a classified balance sheet, and exactly what is that? What we're doing is we're coming up with our total current assets, and you're going to find with different companies, everybody does it the same. Everybody does it differently. If your accounting instructor says put non-current right here, or put long-term, you can. It might not be technically correct. And in fact, if you want to bring them this video and, you know, you can always contact me and I can always try to advocate for you. But Facebook is paying a lot of money to Ernst & Young to go through and audit their financial statements. And so if Ernst & Young is wrong, maybe we'll call up that Ernst & Young partner and explain to your accounting professor why it's okay to do it this way. So in any event, right here, I've got total current assets, right? So I'm showing those assets I'm going to be using within a year. And then here, I'm just dumping everything else down. So property and equipment, intangible assets, goodwill, other assets. And why are these non-current or why are these not current assets? Equipment, unless it's a 7 Series BMW, too soon, essentially will last us more than a year. And that's really the key with property and equipment. Intangible assets, an intangible asset is something along the line of a copyright, trademark, could be a patent. Those typically have longer than a year useful life. Goodwill represents the excess of the fair market value of what I've purchased over the fair value of the assets between the purchase price and the fair value of the assets. That's also considered to be a non-current or a long-term asset. So that's when I look at assets. So again, classified means I'm breaking down my assets into current and then everything else, or non-current. So over here, when I look at liabilities and stockholders' equity, what you're going to notice here as well is we have total current liabilities of $7 billion, and then everything else is just dumped off down here. So here with my current liabilities, I have accounts payable, I've got partners payable, accrued expenses. And so these are all obligations that I need to make within the current year. These are all the $7 billion has to be paid within the year. Then I get down below this, I get to other liabilities. So these must be non-current. So again, current liabilities, those that I have to pay within the year, and other liabilities are just beyond that. Where this becomes very important is that if I'm looking at a company's financial situation, if their current assets here are 50 billion and their liabilities are 7 billion, then it tells me right here that that company is going to be okay in terms of meeting its current obligations. And so this is why when we're creating a classified balance sheet, it's very important that we note what is a current asset versus what is not a current asset. Again, a current asset is considered to be something used, basically, that I'm going to be planning on using within 1 year of the balance sheet date, or that I'll have that's basically going to be liquefied in that 1 year. The other part here is on the current liabilities is that this is going to be owed to within the year. The 7 billion is essentially owed within 1 year. I leave owner's equity alone. So I'm going to pause again real quickly, and we're going to look at one other financial statement. And here we have Macy's. This is their consolidated balance sheet as of November 3rd. So here, just to look at a different type of company, Macy's has current assets of 8.6 billion, total liabilities of 6.4 billion. Again, what is a current asset? Something we're going to be using in the current year. For Macy's, it's essentially these liabilities are different items they have to pay within the year. So you get below current liabilities, you have long-term debt, deferred income taxes, and other liabilities. And that's what you have here for a company like Macy's. So again, this is why when we're doing a classified balance sheet, it's very important to understand how a company, what they can actually have potentially liquid within that 1 year or that one period of time. So I want to thank you for watching today. Please do not forget to like and subscribe. And if you have any comments or questions, please send them to me at 1812cpa@gmail.com. If you're out there and you ever want me to do a problem work through and you're cool with me filming it on Zoom and posting it up to YouTube, I'm more than willing to do it. So just please reach out to me and have a great day, and I'll see you on the next video. Thank you.